Hello everybody and welcome back. Well, the last 24 hours was certainly very interesting in trading and investing around the world. The Swiss central bank raised the rate 50 basis points and sent shockwaves through the futures market. This in turn had very bad ramifications for what ended up occurring, which was, of course, another gap down in the stock market. And it went against some of the things that we were talking about, such as trying to fill these upward gaps. The long leg doji wasn't broken above. It ended up going down, but we've got so much more to discuss. There were some positives. Of course, gold did go up and the US dollar went down, along with yields actually going down as well, which we expected. But the stocks just didn't want to go up. So is this more of a bigger trap? We'll be looking at some surveys. We'll be looking at a whole bunch of data and, of course, going through the charts right now to just understand what exactly just happened in these markets and whether you can stop yourself from getting into such situations. Stay tuned. This will be a great video. See you soon. Well, welcome back everybody to our daily show where we talk about stocks, cryptos, and commodities. I thought I'd start today's show with a quote from Stanley Druckenmiller, who I believe is one of the best investor traders of all time. And he worked with George Soros, and he has a quote here. Soros is the best loss taker I've ever seen. He doesn't care whether he wins or loses on a trade. If a trade doesn't work, he's confident enough about his ability to win on other trades that he can easily walk away from the position. And I thought it would be a good place to start today because, of course, there were some things about the previous 24 hours that were a little bit different in stock markets. And I'll be discussing that later on today's video as we go through the indices as per usual. Let's, though, talk about what actually happened in the session. And it was red from the start. With the Swiss central bank doing a surprise rate hike, it sent the futures markets into a spiral, plus, of course, all the normal negativity around, and it was just really starting massively red. We basically opened on the support on the down low for the SP 500, and as you can see here, everything was red for the session. The markets opened around 2% and a bit down, then they just continuously fell through the session, and they had some recovery buying at the end of the day, which we'll talk about a little bit later. Funnily enough, things like the US 2-year and 10-year both dropped, but that didn't have much effect on the buyers until the end of the day. So another really poor session here for the markets in the continuation of the weekly and daily downtrends. Let's talk about gold. Gold was up 1.89%. It was the one thing that we were very correct on in the last couple of days. We've been pretty good here navigating gold. Unfortunately, the stocks weren't as good in terms of navigation last 24 hours. We'll talk about that soon. But as you notice here, clean energy, semiconductors, solar, all of the risk on, everything was down, and the market was really getting out of those positions, or at least it seems like that's what they were doing. Let's move over to the newest survey. So we have the new survey I put on our Twitter, and if you want to follow FX Evolution on Twitter, I post some of these things. And this is, of course, the AAII survey, and it shows that 58% of people from the previous survey, which was taken right around that FOMC meeting, they're bearish. And you'll notice there's big shifts here. Look at the dates, and funnily enough, look at the markets and what we were in. Only 19.4% are bullish now over the next 6 months, and 22.2% are neutral, with most people having an incredible negative tinge. Now, if you're a capitulation-based trader, let's say you don't trade with stop losses and you have a massive faith and you like these types of things, then of course that's the type of thing that may interest you, of course, buying into the fear. But as we said, the last structure setup didn't quite work out. And I think a lot of that was the Swiss central bank and then, of course, the algorithms getting involved in it. The other reason it could be is this one, quadruple witching. Yes, this is the Friday where all of the options expire. So, of course, we have this in March, we have this in June, September, and December. And it's every third Friday at market close. So the amount of manipulation of options that goes into this particular event can be significant and severe. I probably should have really prefaced it because the Thursday, that is the day before the options market, often is negative, and that is actually the high volatility day. Because of the setup, because of what we saw, we didn't know if that would happen, but quadruple witching is a serious day, and a serious amount of volatility comes through the Thursday and Friday session. So it's where stock index options, stock index futures, and single stock futures, of course, all expire at once. Let's move over to some more positive news, I guess, in some ways. The number percentage of, it's not really positive, but S&P technology companies has now hit 90%. Now, why I say it's more positive is you'll notice some boxes here in terms of what that has meant in markets. Now, other than really bad, what ended up being, of course, the tech wreck or even the GFC, you'll notice the boxes during these periods of time don't necessarily mark the lows, but they start to mark, in most opinions or most cases, somewhere near that kind of more investable level. I was listening to an interview with Druckenmiller. I'll post it actually in our Discord and maybe post it on our Twitter as well, so definitely follow. It's a great interview, and he says a few things that are really interesting, but even he's not betting against these big tech companies at these prices. He did, and of course, I knew he was doing that, and that's something that he has posted now in his filings, but at this stage, you know, he's not positive, though he's not necessarily negative on the current valuations. An interesting point there. Speaking of other things, we just saw recession at the search term in Google United States search term here go to the same level that basically we had during the March 2020 crash, where we did actually hit a recession. And that's another interesting one. The spread of the idea, the spread of fear is extreme in these markets right now. And I'm not saying, by the way, that I don't think markets can go lower this year. 3,200 and especially 3,500, where the SPY sits on the 200 simple moving average, we're always on the cards for what we've been discussing. But we do believe that things like dead cat bounces and of course rallies do occur. And sometimes when max fear is coming through, especially with the stats we've seen recently, it can cause, you know, a bit of a change in trend, which you've got to be very, very careful of. We've seen that a few times in 2022. Let's talk about quantitative tightening. Obviously, a choppy time in markets in history. We're in that point again at the moment. So that's something we brought up in the previous one. And we're now, of course, more than 4 days through this stat. But I just wanted to bring up again a point where when you have 4-day declines of 9% plus, it's rare. And when it happens, yes, there can be even further selling, such as what happened in 2020, such as what happened in 2008. But at the same time, it does point to that kind of spread of fear. And for the investor, it gets close to where that point of turnaround could be. So just remember that it's a little bit different to what everybody else thinks. 50% yield curve inversion, we still look for that. We won't mention it anymore because, of course, until we get to that point, there's not much point of discussing it. Let's talk about the VIX. The VIX jumped again, hitting 35 max fear. This level here has been very, very good at kind of showing the lows or showing the fear and the Bollinger and all of those types of things in the market. It then fell from that point and went down. Is this a good sign? Well, I guess it can show you that maybe the fear for the quadruple witching was really all in the Thursday day, and that's why it went down. Copper also fell heavily. Now, a lot of you will see this as a Wyckoff distribution, and rightfully so. Here's your UT or UTAD. Here's, of course, your buying climax. And realistically, copper, if it falls through this low, is showing us economic slowdown, most likely recession. All of those types of things are coming through. It doesn't mean the market has to crash. Copper has fallen before, but it will knock around metals markets specifically. So if you think about it and you go back through time, when copper fell in 14, which it fell through this point here, that began a very wild sell-off in things like the FTSE, the ASX, etc. So be careful here on copper. Dr. Copper doesn't look too healthy, and it's consistent with what we're hearing and seeing in the markets. So where were we correct in the last 24 hours of videos? Well, we're correct about the 2-year. The 2-year did rise, and then, of course, it's fallen back through to a new low here off this previous session. Theoretically, this is pretty good. It does signify change of trend, which we thought here, and of course, that was the idea. If the 2-year and 10-year continue to go down, that has a positive effect on the market, at least initially. Yeah, so we've sold back off, but if this continues to drop back down, it will bring the market back up usually. That's the kind of correlation it has with it. They're no longer inverted, so 2 years at 3.1%, 10 years at 3.258. And again, they're well off where they were the other day when they spiked up 3.5-ish, now down to 3.25. That's theoretically good for markets, although still incredibly high, and the Fed is nowhere near those rates at this point. But this is what the market sees. The Fed is just playing catch up at this point. We all know that. US dollar, pretty good one. Definitely looks like a distribution here. This is, again, a Wyckoff style distribution. We see the excess phase. Now, let's just show the excess phase in the market. So what the market's done is it's sold off That was our initial kind of area that we spotted together right here. It then went on to make a new peak, which we've seen here after the turnaround. And now it's done another very similar distribution with a sell-off. So yes, it probably can rally, but it looks like it's weakening here. And this is the right type of signal that a lot of people would have been looking for. And if you were trading currencies, actually, there was a lot of really good currency setups in the last 24 hours. We'll just quickly look at odd, just so you can see replication. So this is actually a very similar style to what we've been talking about in other markets, such as gold. You see the rally breaks through the supply. It comes back to grab the demand here, and then it rallies back through. So as I've mentioned several times on this channel, during times of maximum fear, that is 25 plus VIX, sometimes it's best to go to currencies, metals such as gold, and of course, focus on your indices. And we will be focusing on those very, very soon. Let's move over now to gold and just talk about this one. Here's our demand level that we discussed. The demand level did hold up through the session. The beginning of the session in the US was actually very bullish because US dollar was dropping so hard. Now, the question a lot of you will have, well, if the US dollar is dropping, why wasn't money jumping into things like the stock market? Well, I think a lot of it's got to do with, again, the Swiss franc and the ramifications of a surprise interest rate hike such as that with the safe haven has made a lot of money shift around the world. Now, I'm not going to pretend I know exactly where all of it's gone, but still, I think that the US dollar dropping could be a positive sign for bonds and for stocks in the next coming days. We'll find out whether this is all just manipulation as part of the quadruple witching event. So a nice demand area, obviously a good turn in here that was allowed to, purchase in if some people wanted to, and gold is moving up. Now gold, even Druckenmiller believes in this, and I also believe in it. Gold does well during two things. Stagflation, it's an amazing asset. While people if we are in stagflation, that would be a big thing. During economic slowdowns, recessions, it does fall with, of course, the market, but maybe not as high as in terms of percentage. And because it's basically a currency. And the other thing that can happen is if we see US 10-year continue to drop, you may actually see gold have a decent time. I'm starting to think that gold might be the asset of choice in some ways in a market like this. And while I'm not recommending it or anything like that, I just think it's an interesting idea. And for a little bit here, it looks like gold could be something that is potentially under what the market's expectations are. Take a look at those demands. The levels here have really been turning around. Gold's been doing much better in the market than it used to. And we've got this huge supply issue up here around this 1870, 1880 area. So we'll find out whether it can get past that. But certainly interesting here. If the US dollar continues to drop, gold would probably do well off that. US oil dropped again, then rallied in one session. Let's think about what's happened here. Change of trend occurred, at least in our opinion, at around this point here. When it breached underneath that last demand zone, it then sold off, it rallied, and at this stage, it's still looking relatively weak. Oil's a tough one. There's a lot of geopolitical stuff on this, so if you like it, that's at least from the technical standpoint, it's done at least the smaller time frame, 1 hour, 2 hour change of trend, but it certainly hasn't gotten underneath the daily yet. To do that, it would need to break underneath that 112. We'll find out whether it can do so in the next 24 hours. XLY, XLP, risk was off, but risk is still theoretically on compared to where it was. And I know that seems really weird. Consumer discretionary versus consumer staples, still higher than it was during the previous lows. So if you notice here, 11th of May and 24th of May, the market is actually selling off the metals and energy at a faster rate, and some of the other sectors at a faster rate, the defensive ones, than actually the really high kind of risk stocks, which may show a little bit of bottoming to a degree in comparison. So that's a positive side for people that are in the risk, that may be stuck in those positions. Negative 4.17% on the ratio is not great, but it's still much higher than where it was. Bonds also, I'm telling you right now, did hold in terms of just pure risk in the last 24 hours, which is strange. Usually you would see the market go up with those types of things. Now, Apple, what's going on here? Well, there's a new low, and Apple fell through to a new low. We've got this previous demand here. We're not there just yet. That would push Apple into around a 125 price. It's sitting at 130. Is there much supporting it? Not really. But of course, I think this will come down to the stock market, the SP500, the Dow, the IWM Russell. All of those things will hold it more so. Tesla did enter the demand zone. It entered that line we've had here for a while, 625 through our demand area. It bought near the end of the day, so we did see some buying, but very wild price action on these stocks at this stage. So Tesla's technically in the demand, and if they fall through this level, especially Tesla, I'm just going to zoom out here. On the daily, there is almost nothing holding it up until we go all the way back down to 550. Well, basically, I don't think there is much holding it up, maybe 575. So there's some significant drops. If we went from this percentage down, you'd be talking about another 14-ish% just to get to that low. So be careful out there, guys. It's a wild market, obviously being nimble and fast and being prepared to take losses, such as the quote we had at the start. That may be the way that you've got to think about these markets right now. They're quite tough. IWM, new low, not good. I don't think there's anything positive about this chart. If you're looking at it, it just made a new low and it looks pretty bad. It did fill, I guess the only positive is it filled this, which it left, this gap that it left over here previously during its rampant run in 2020 into 2021. But yeah, it's all the way back down. It's back to previous kind of resistances. In fact, it's underneath the 2020 high and the 2018 high now. And the small caps are not being liked. Again, it's another negative day. But this stock market has left quite a few gaps. So the gaps still remain. We've got one gap, two gaps. I laugh because there's just so many gaps. Three gaps. I don't know if I've ever seen so many gaps left in the wake of shorting on the major indices. Let's talk about the US 500. I guess we have a little inverse head and shoulders structure here setting up. But I want to talk about the last 24 hours because, of course, a lot of people are saying, why were you even thinking that this thing's bullish, man? It's obviously a trap. This was obviously a trap. And yes, you could say so. So I want to just explain a couple of things. I see that as a supply. Now, I could be completely wrong. Maybe the supply is a little bit higher. The supply that was created here was, of course, on the futures market. That's the problem, most likely. The other thing is we ended up creating a daily doji off the Fed result. So that means that you have this daily doji. Effectively, a daily doji is equilibrium or indecision in some ways, depending on how you see it. So really, if you were day trading and you'd closed the day before due to risk parameters, etc., you would have wanted the market to make a new high. At that point, it signifies that all of this potential max pain spring, all of the setups we discussed, were going to keep, and of course, ramping, and there was plenty of money on the table for the gap closes. So that's one solution. The other thing is it all depends on your entry, doesn't it? Where did you enter? Did you enter at the close up here because it went to above? Or were you entering at more of a pullback level, such as this level here, with tight stop losses that got hit? So this is where risk mitigation comes into it. If you get into trades, it's all about playing stats. If you had gold, maybe a currency, and the stock market in the previous session, yeah, you probably would have lost for the long on the stock market, but you would have won on the gold and potentially the currency trades. The main thing is, and I've written it up here, is patience, react, don't predict. And what I mean by that is if you see setups, let's say you were in the shorts all over here, and unless you were getting out and being nimble and fast, you could have been ripped apart. If you were picking up springs down here or you're picking these levels, you are in control of your own stop losses. Whether you put a stop loss here, whether you put a stop loss underneath here, you don't need to ride the entire negativity. For people that were looking at the shorts, I guess that's probably what I would say at this stage. This supply that we were looking at, maybe the mistake was that it was done on the futures market and not so much on the real market, not enough structure set up for it. And of course, at this point, this was a false break, similar to a lot of these rallies we've seen recently with these setups. And then, of course, it dropped back down. If you're thinking about trading the previous session, this was the area of choice. I've highlighted it here. Previous wick, of course, purchased off, previous wicks over here. More importantly, when we dial in and look at the smaller time frame. So let's just do that. Let's do some critical thinking here. I did this with the private community. If you're ever interested in joining that, you can jump into the free 7-day trial. Links in the description down below. But here is the supply that we saw leading in. So it went bang, bang, new low, consolidated up, came up just before the session. You can see the volume coming into the session. And what ended up occurring was it shorted off this supply. Now, if the market had breached this supply, it becomes quite replicatable to say, boom, boom, go to fill the gap, get that 3780. That becomes the next likelihood. So this was a very interesting point, and a lot of people especially shorters, would be trying to short here, putting stop losses just above, getting those tight scalp kind of shorts in. And that was probably the best short of the day if you're trying for it. And if you're looking for a long, well, that was the chance for a long, but it didn't breach through. And that's the most important thing. Let's look at the next 24 hours. At this stage, we know we still have this level here to contend with in the future, but we also have this new level that we've created around this area here, which is pretty much around 36.90. It effectively is also the previous support. So we've got quite a few probably orders sitting around in here. We have a setup at this stage that looks like an inverse head and shoulders. It's up to you whether you like that type, whether you still want the bullish side or you're looking for bearish. But where are the bears going to be sitting? They're sitting somewhere around here. They're sitting somewhere around here. And the bulls are looking for this type of thing, pull back, this type of thing, move to the gaps. We have 3 major gaps now on the SP 500. That's a huge amount of gaps. We've got a gap here. We've got a gap here and a gap here. As I said, that is a lot of gaps. So coming into quadruple witching, there's no doubt shenanigans going on in the algorithms, in the Wall Street, and the manipulation and everything that's occurring. That often does cause some very strange reactions in the US markets. So this is going to be one for a very interesting day trade. I think I'd be nimble and quick, and of course, be structuring up, making sure that you understand your risk parameters and all of that. And of course, I wish everybody out there the best of luck. At this stage, it's clearly in a downtrend, but there are some signs that maybe there's a little bit of turnaround, but it's still in the downtrend. And as I mentioned before, if you're looking at where do these markets generally stop, we've brought this up many times before. Let's add a 200 SMA to the chart, and we'll do that together. And we'll go back through history. Let's have a look at history here quickly. Might as well do this. Let's just quickly jump this one, get the green. I like green for the 200, and we'll go to the weekly. We'll check this out. So here's the 200 sitting on previous resistances and doji, and here is the 3500. Notice they sit with each other. So this is one of the case scenarios, along with the 3200 case scenario, that seem the most likely areas in an epic collapse at the moment to also be pretty big buying zones from the street. If you think about it, this 200 has been hit only a fractional amount of times in history, but when it does get hit, it loves it. It sits on it and then it actually buys off, or it sits on it, has a bit of a ramp, it sits on it, has a bit of a ramp. It's a critical level. Of course, during the pandemic, it jumped straight through it, but that was even more fearful in this market in terms of the speed at which it was going. It was very, very quick. So yeah, 200, 3,500, lows down here. The bigger picture, that's what some people are targeting this year. And how it gets there is really what a trader is looking for. They're looking for trading up and trading down through this very choppy, very difficult market to look at. In terms of the options expiration, we'll just quickly refresh maximum pain here for the level. It's going to be pretty irrelevant, I think, because we're so much further down due to all of the prints on the inflation and everything else. Technically, max pain is still 412. It's not going to work this week, is it? So we're not going back there, but it's interesting to see it still above. Let's talk about Bitcoin. Bitcoin coming off the low of 20,200. It's at that point again. It's just created 2 little 1 hour dojis, long leg dojis. Probably a little bit of orders here. This is a demand level. Will Bitcoin hold it though? We don't know that. Where's the big supply that kind of changes it? Around 24,000, and everything in here is mostly noise. Buyers will try to buy this. If it goes through, you're really not looking so good for Bitcoin. I mean, unless it goes bang, bang like that and creates a max pain scenario, that would be very negative. So Bitcoin at support, at least through the Asia into European sessions. As we know, there is also another Bank of Japan press conference coming out, and we've also got Fed Chair Powell speaking as well, 8:45 a.m. New York time. So Papa Powell's coming out to ruin our day, or maybe he'll make it better, into quadruple witching. Let's see what he has to say about the market and, of course, interest rates moving forward. Thanks so much. If you enjoyed today's video, please subscribe, smash that like button, and best of luck out there, guys. Hopefully, we start to see some really nice turnarounds, structure formation, and all of those types of things. If you were short in the previous session, well done to you, and I wish you all the best. Bye for now.